Hello, hello. Hello. Yeah, Mr. Henry, can you hear me? If you can hear me, let me know. So far you are the only one that have joined, so I'm waiting for them. If they've not joined, then we will just start. If you can hear me, just type it at the comment section. Okay, all right. So I'm waiting for the other guys to join. So, Mr. Henry, let's start then. Yeah, let me check. So you can call which number? Yeah, yeah, you can call me. Please, you can call me. You can call. I'm waiting. Yeah, can you call them? Is it on the page? You can call on the page and see. Because we can't force them to. So whoever is ready then. So you can call them and let's see. Okay, so first of all, when you open the chart, you will have to check the overall trend of the market. Okay, the long-term trend and then the short-term trend. So, for example, this is the daily time frame of Bitcoin US dollars. And then when I open the chart, you could see that the market in the long term has been trending to the upside. So you can see clearly that this market is in an uptrend. That is the long term trend, which is an uptrend. And then you can also see, you also realize that this market in a short term is trending to the downside. So in a short term trend, and then the short term the market is trending to the downside, and then long term the market is trending to the upside. Now, where we all know that we join the trend. So first of all, you look at the current price the market is, and then you check retrospectively. First of all, retrospectively, you are going to look out for an order block, or you are going to look out for a fair value gap, or you are going to look out for a demand zone, or a support zone. So in this particular market, the market is trending to the downside in a short-term downside, long-term uptrend. Now, in a short-term downtrend, where is the market going? That's the first question you have to ask yourself. Where is the market going? So the answer to the question, where is the market going? First of all, the answer is going to be one. Is the market going to fill a certain fair value gap? That is the first question. The second question is there any other block that the market is going to fill? Two, is there any support that the market is going to test, or is there any demand zone that the market is going to? So these are the four answers to the questions. So fair value gap, a support, a demand zone, and um, an order block. So what is an order block? The order block means that a specific market price that there were a lot of orders. So where, for example, for this particular one, in a long term, the market is in an uptrend. So where previously the market was, a lot of buyers came on the market and buy the market to push the market strongly to the upside, is what we call an order block. So the order block is similar to a demand zone. So it's similar to a resistance area. Okay. Sorry, not a resistance. What do you call it? A support area. Okay, so the support, we all know support and resistance are actually a particular market price, while a demand zone or supply zone are actually a zone, a particular market um, zone where the market is likely to buy or likely to sell. And then another block is actually where the market was bought or was sold. So in this particular one, you could see clearly that when you open the chart, this is the daily time frame. So um, I'm starting the analysis from the daily time frame. I've done the analysis already, but I'm just trying to go over. So you could see that I think last Saturday I put it on the page that the market is likely to buy somewhere here, and so over there, as we all know that on Saturdays, the market ranges. Okay, so we saw the market moving around that area. And the reason is that we can see that there is what we call an order block. This particular area was an area that previously put the market strongly to the upside. And so that area becomes area of interest. So you can't overlook that because the market is likely to buy at that particular area. In fact, if you are looking for, maybe looking for a sniper entry, or you are a day trader, or you are looking for a short term, then you have to put a limit order at that particular site. The limit order is actually an order that you place into the future. So you can place your buy order at this area, this market price, that in the future when the market reach that particular area, it should buy for you. Then you place your stop loss just beneath it. The only problem is that because of liquidity sweep, when you place a limit order over there, sometimes it can sweep liquidity and then your stop loss will be hit. So most of the time, we wait for the market to hit the area. You demarcate that area over there. Then you wait for the market to hit the area. Once the market hit the area and the once the market hits that particular area, okay, and once the market hits that particular area, if let me say you place a limit order over there, because of liquidity sweep or liquidity hands, what can happen? It's not always all the time that you are going to be stopped out, but it's likely because the big institutions knows that many retail traders will place their limit orders over there, and then their stop losses will just be placed just beneath it. And so what will happen is that because of what do you call it? Because of uh, a liquidity sweep, when you place it, um, so once, first of all, because of liquidity sweep or liquidity hand, at this particular zone, when you place your limit order over there, we all know limit order. Limit order is an order that you place into the future that because of this order block, when the market hits this area, you are expecting the market to start buying. Okay. And so you place a limit over there, a buy limit over there into the future over there, waiting that even if you are not on the chart and the market get its way to that zone, it should buy for you, then your stop loss will be placed just beneath it. But because of a liquidity hand, sometimes the stop loss are being hit because the markets will try to sweep a liquidity before it starts buying. And so but it's not always all the time, but most of the time. So what you do is that you have to demarcate that area. That area becomes your area of interest. And so you place your trend line over there, the horizontal trend line over there to wait for it. And then we have another one. So when this one hits and the market break and close below it, then you know that the next area of target is going to be this demand area. Okay, so once you place it over there, what you do is that you change the time frame to a lower time frame. So this is my daily time frame. If I change it to a 4 hour time frame, you could see clearly that that area, this area, you can see clearly that look at the left side here. This has been an area that pushed the market all the way to 24,000. all the way. So looking at this area, this is the area we've demarcated at the daily time frame. And that area is an area that bought the market. So once you've demarcated this area, and then probably you've placed um, your limit order over there, in the future, when the market hit that side, it will begin to buy for you. Okay, so we've established that the market in a long term, the market is bullish, but in a short term, the market is bearish. But where are we expecting the market to buy? And that is an example is this particular area. So currently, last week, sorry, this told you that the market will begin to buy somewhere around this market area. And so we saw, as we all know, on weekend, the market days, we saw the market ranging at that area, trying to get a momentum for the market to start buying. And so we saw from 4 noon, that's from 4 a.m. this morning, we saw the market starting, to be bullish at that area, and you can see how strong the market move. So once there is a confirmation that yes, indeed, this particular area is going to push the market to the upside, then you check the time frame that you are going to trade, either the 15 minutes time frame or the 30 minutes time frame. So we have the 15 minutes time frame. So this is our 15 minutes time frame. Okay, so you can see clearly what happened over there. So even if when you place your horizontal line at that particular point and you check, you are waiting, you will be waiting to check what happens over there before you enter into the trade. So even at the 15 minutes time frame, you can see what happened. We saw the liquidity sweep. This is here. So instead of the market to start buying here, we saw the market to be, close, push below it before we start buying. So if you were online, what you do is that your lower time frame has confirmed that indeed that area is going to buy the market for you. And what you are going to do is that you will look for an entry. So probably at the close of this bullish engulfing candle, then you enter the market for a buy side. Then your first take profit should be the recent resistance area, which is here. And you could see clearly the risk. This is going to give you a very nice risk to reward ratio because that is an order block, that is a demand area that push the market. So imagine your stop loss is placed just here, just beneath the bullish engulfing candlestick, and then your take profit is going to be just above, or it's going to be at the resistance area. So you can see about almost about almost 1:10, 1:5 raised to reward. So because the stop loss is just small, but the take profit, look at what it got to before the market and that area started, slow down. So what happened is that I've already told you that at the demand area where you are expecting to buy, one, from the chart that the market is likely to buy at that point. But you also know, you also need other confirmations. And what confirmation do you need? You will need something like a volume indicator. And I've told you what the volume indicator is used to. It's used to determine the quantity of people that are supporting the move. It determines the number of people that are trading at that particular time. So if at this particular area we saw a spike in the volume indicator. So the volume indicator spike up. That shows you that there are a lot of people supporting that, yes, the market should be buying at that particular point. And so, first of all, the market was in an order block, or the market was in the demand zone. Secondly, it was confirmed by what? A volume indicator. And you've got no choice than to enter the market, place your stop loss just beneath the previous candlesticks, and then hit and your take profit should be the recent resistance area. So this is how actually this is actually a sniper entry. So a sniper entry, you have to wait. So usually it takes time for you to get even one good entry, but when you get an entry, it's the risk to reward ratio is very nice, because you can just risk, let me say, $1, and you'll be making like $10. If you are making, or you are risking, let me say, $10 on that particular trade, you will be expecting something like 100 to $150, because you've entered the market at the right time. Now, my question is that when, for example, this particular time, we did not enter the market at this particular time. So, what are we going to do? At this particular point, are we going to buy here? No. If we entered here, we can hold the position, hoping that it will continue to push them. And indeed, it will continue to push to the upside. But then there is going to be what? A retracement, because we saw an impulsive move. There should be a retracement to retest this area. Then the market will continue with the uptrend. Now, what are we going to do? Do we have to wait until the market retraces and then give us a support that will put the market to the upside before we join? Or do we have to just buy? So the answer is that you will have to wait. You have to wait. So when you open the chart, you know that okay, the market started buying over here. Where it is right now is a resistance area, and that is why we saw this rejection and the next one. So we will have to wait to get a confirmation that the uptrend will continue. Then you enter right. Now let's go to maybe the 1 hour time frame. Good. So you see that in the 1 hour time frame, you see this bullish engulfing candle, and then where the market is right now. Yes, so honestly, this market is going to be bullish to it's going to move all the way to where it came from. And what we're going to do is that, because we will have to wait, because we've already missed all this move, we will have to wait for the market to retest this zone, and after that we will join the uptrend. Okay, now whilst we are waiting, sometimes the market, it can take a very long time before the market starts giving us a confirmation that the uptrend, it will begin to it will continue with the uptrend. So what we will do is that we can join maybe the downtrend, the short-term downtrend, we can join it. But then you have to be very careful, because the profit you are going to take is just an profit. And if it's a short-term profit, then you have to be mindful of whatever you do, because when the market reverses and starts buying, it buys strong. So if you are taking any risk of selling, then you have to make sure that you are not going to be in it for a very long time, maybe maximum 15-30 minutes. You've taken profit, then you enter the market. So usually that's how we trade the market. Now, if you are joining a short-term trend, and last time I told you, you don't really need to trade 30, for a whole day, or you don't need to trade for hours. Sometimes it's just 30 minutes, 1 hour candlestick you are going to trade. And so what you are going to do is that, once you are waiting to join, you are waiting for the market to buy, then you join the buying market. Sometimes you will see sell opportunities as well, and that sell opportunities is a very short term time. So it's a very short term entry, and you will not hold the market for long. So for example, you can be looking out for, maybe if you are looking for a short term entry, then you'll be looking out for maybe a bearish harami pattern. And we know bearish harami, an example, this is an example of a bearish harami. Where is it? Uh, Example of bearish harami over here. Let me change the time frame to maybe 30 minutes. Um, so this is an example of a bearish harami pattern. So we saw a bullish, strong bullish engulfing bullish candlestick push to the upside, retest this resistance area. And after that, the following one, we were expecting that the market to continue to push to the upside, but it did not. And then we saw this bearish candlestick fall just close to that resistance area. And then after the bearish engulfing candlestick formed, what happened was that you realize that this bearish candlestick, is smaller than the previous bullish candlestick. So the previous bullish candlestick or the previous candlesticks engulfs, or we call it a mother candlestick. So it engulfs the recent bearish candle. And because it is close to a resistance area, in fact, we know, or that tells us that the next candlestick that is going to form is going to be bearish. So we have, because we made our decision on the on the 30 minutes chart, we know that in the next 30 minutes, so we are guaranteed that the next 30 minutes is going to be bearish. Then when you enter the market for a sell side, you are expecting to take your profit at the close of the 30 minutes candle. If it closes and there is confirmation that it will continue, then you can hold it for a maximum 1 hour. Then you take your profit because it's a short-term trade you are doing. Okay, so this is an example of a bearish harami pattern. So in fact, the harami pattern, the the um the teaser bottom and the teaser top, the engulfing bar, all those ones are very important, and you can trade them inside a trade. Once you are looking for maybe a long-term entry, you can be trading those ones in a short term. So those ones, you will not hold your position for a very long time. So for example, with this one, so for example, with this one, all you're going to do is that you hold a position to a maximum 1 hour. You take your profit, then you wait. Okay. So over here, we all know the market is bullish right now. So we are going to wait and look for an entry. And where it is at a resistance zone, and you have to wait for the market to give us that momentum, or for the market to retrace it to the downside. Then we can join the uptrend. Or whilst we are waiting, if we get any pattern that confirms that the next one or two candles is going to be bearish or bullish, then we join the market. So this is actually how we trade. Now, you have to master the harami pattern, the bullish engulfing, and then the bearish engulfing. Then you have to also master the pin bar. We trade the pin bar in a short term, I'm sorry, in a long term trade. Usually when the market is at the resistance or support zone and you saw a huge rejection. Okay, for example, this particular candle, which is called what, a gravestone in a 30 minutes candle. We saw this gravestone doji candle, this particular one before the recent one. That's a gravestone doji candle. When the gravestone doji candle forms close or at a resistance zone, the market is likely to sell, or not to sell for a long term, but a short term sell. The market is likely to begin to sell to the downside, or maybe the next two or three candle is going to sell. That is what we know. Okay, so you have to wait to get a confirmation, then you enter the market. So, in fact, from a whole of this month, you are going to do more of trading. So, once you have your account ready, when you join the live, all we are going to do is we are going to look for an entry to join the market. You are going to look for an entry to buy or sell the market. Okay, and then if most of you one thing that makes that what do you call it? That makes an entry is the timing that we come on live to trade. So if we are all going to have an agreement that um, maybe in 4 hour interval. So for example, sometimes at 4 a.m., for example, this particular market began to move, push strongly from 4 a.m. That's where we saw the actual move. And I know most of you will not be online at that time because we will all be sleeping at that time. But me, any time that I sleep and then I wake up, I check the chart. Where is the chart? What is the market doing? So I trade at any time. And then I can wake up at 12 dawn. And when I realize that the next before 4 noon, 4 dawn, the market, that 4 hour interval is going to be bullish, then I trade. So there can be opportunity at any time. It can be in the dawn, it can be during the daytime. So once we are trading in the daytime, we will have to wait to get a good entry, then we will enter the market. So once you all have your accounts ready, what we are going to do is to wait patiently to get an entry. If any of you have any question up to this point, kindly put your questions at the comment section and then let's discuss your question whilst we are waiting to get an entry. Because at the end of this, by the end of this month, I expect all of you to be able to make trading decision on your own, or you should be able to, make trading decision on your own. And because most of you have a very small account, what you should be doing, you are not going to take a very huge risk. It's just a small risk you should be taking. So your loss size should be 0.01 from the start. And as time goes on, that you are, you know, um, you are increasing your account size, then you can be increasing your risk, as in your lot size, small, small. So that's what we are going to do. All of you just deposit. In fact, you can decide to trade demo, but the truth is that the demo trade, if you trade demo, you trade with the demo for 100 years, and you think that you have gotten a strategy or you are now okay to start trading with the live trading. When you start the live trading, it will take you back back to the beginning. The reason is that there is no emotion attached to a demo trade because it is not real money. It is not your money. It is not money that is coming from your pocket. And so when it happens like that, there's no emotion attached to it. So it's better you start with a real account, and start doing the right thing there, and understand how the market affects your emotions. Because sometimes you can enter a trade and then the market is moving close to your stop loss. Then you will be panting because maybe you might be thinking that it's going to hit your stop loss. You must go through that experience. You must experience that. So I will not recommend that you should trade demo trade for years, or for months. No, it will still take you back. If, let me say, you traded demo for 3 months before starting with the live trading, when you start the live trading, the you will be taken back to the 3 months, because the feeling now is going to be different, because now you are trading your own money, so it's going to be different. And so it's better you start with a live account and follow the right mechanics of trading, follow the right, entry point. Once you do that, in fact, maximum within 3 months, you should realize that, like, you should see an improvement in yourself, that now, anytime, any day, you can open the chart and then trade. And that's my aim. Once you are able to trade on your own, that's it. That's it. So one thing, have you realized that because this area is a resistance area, and then this particular gravestone they deformed, the market is not able to push strongly to the upside. So if you just because the market is buying, if you buy, it can begin to sell, and that sell can hit your account or will hit your your stop loss. That's why if you are late for entry, you have to wait to get an entry. In fact, you have to master patience, master discipline. In fact, if you are not somebody who is disciplined, you will struggle so much in foreign. You will struggle. Bet me. You need to be disciplined to the highest level. No successful forex trader is not disciplined. It's not possible. So you need to be disciplined. You need to have patience. Patience is also very, very important. Okay, so we are waiting to get an entry. In fact, we have to wait to get an entry and then we'll join the trend. Or if we are going to trade the trend, then we need to get a good entry, trade for some minutes, then we will um, take our profits, and that is it. So if you have any question, you can just put it at the comment section, and also make sure you like as well. If you have any question, you can put it there, or you can put it on the WhatsApp page, and I'll respond to that. So we are waiting to get an entry, guys. So up to this point, if you have any questions, we will kindly ask, and then I'll respond to that. If you have any questions, you can put it on the WhatsApp page, or you can put it at the comment section here, and then I'll respond to that question. And if you have any question pertaining to the analysis, how I analyze the market, let me know to go over. Let me know to go over. If you have any question about the market analysis so far, let me know. So whilst we are waiting to get an entry, if you have any questions, please let me know. You see, at the 4 hour time, the whole happen, this is what we call a double bottom. And when a double bottom is formed, we have one bottom, we have another one. When a double bottom is formed, the market moves strongly to the upside, and that's what causes this market to move strongly. And it's formed at where a demand zone. It formed at where a demand zone, or at area of an order block. And because of that, that's what started, buying the market. So that's what we call a double bottom. One bottom, another bottom. So your market structure, you need to master it very, very well. In fact, if you place an order here, a limit order here, waiting to buy, right? By now you would have been in a huge profit. And in fact, the next 4 hours to 8 hours, I'm expecting the market to continue to be bullish. So we need to get a good entry, then we'll enter. In fact, if we can get just one or two entries for the day, that's fine. So we will not be here for the whole day. Once we get a beautiful entry, once or two, we enter, we move on. So that's it for Bitcoin. If you have any question, please let me know. Or if I should change to gold, then we'll check how gold market is also going to uh, move for the day. So if you have any question, please let me know. Let me know, because this is the only time. This is the only time. Okay. Explanation on when price has moved from entry. You wait. Okay. Okay. So I'll respond to that. Okay. Okay. Gigabyte. Okay. All right. I'll respond to that. Okay. So this is when you are expecting to buy the market here. Here. Okay. And then when you open the market, you realize that, oh, the market has already moved moved away from that, meaning that you missed that entry. What are you going to do? You are going to wait. Now, first of all, it has moved from there. Is it a buy? Is it a bullish um, market? Yes. So if it's a bullish market, then what you are going to do is that first of all, you check how long has the market moved from your area of target. How long has it moved? Assuming that when you open the chart, we saw about three bullish engulfing candlesticks here. So we have another bullish close to this resistance area. You have no business to buy the market. You have no business to buy the market. The market is at what? A resistance area. But the market is not, is bullish, and it has moved from your area of interest. And you are expecting, you are looking for an entry to join that market. What you do is that when you change the time frame to your 15 minutes time frame, for example, this is my 15 minutes time frame. And we all know that we enter the market from the 15 minutes time frame or the 30 minutes time frame. Now, this is what you are going to do. Currently, this market, from the 15 minutes point of view, this market is at here. Okay, here, this area, which was previously a demand area, has turned into a resistance area, and that is a resistance, another resistance. So the market is evolving around that area. So what you do is that you either have to wait for the market to retrace to the downside. So, well, you can use the Fibonacci to do that. Very, very important. You can use the Fibonacci to, what is the Fibonacci to? Oh, you can use the Fibonacci to, so that is the Fibonacci. Then you draw your Fibonacci to, this is it. This is it. And we all know how to draw the Fibonacci already. So this is your Fibonacci tool. Good. Now, where are you going to enter the market? You are going to wait for the market to retrace. So the market should have to retrace to either 0.38.2, sorry, 0.382, or we usually round it in percentage. So 38.2% here, that is the yellow line, or the market should hit the 50%, which is the 0.5 range. So if the market retraces all the way to this area, you are going to look for a buy. How are you going to? The market must make what you call a demand, with the market must make some form of support over there. So you should see the support I'm talking about can be, it can be a bullish engulfing candlestick. It can be, it can be a bullish engulfing candlestick. There should be a rejection, which can be a pin bar, either a hammer pin bar or a doji candlestick. It can be a harami pattern formed over there. So once the market retraces to the 50% Fibonacci level, and then we saw any of this pattern, a bullish engulfing candlestick formed, then you buy the market. And that one, you are, in fact, the risk to reward ratio is very beautiful because, first of all, the market has retraces into your 50% Fibonacci level, and after that, then you, when there is a support or when you see a bullish signal like a engulfing bar, maybe a harami pattern, maybe a rejection, any of the hammer, any of them, then you enter the market. So usually when you miss your entry, that is what you will do. The market, this one, it will not go straight all the way. No, it will definitely retraces, and after the retracement into maybe the 50% or the 38.2%, then you buy the market. So that's how you do it if you've made your entry. Please, do you understand? Gigabyte, do you understand that? If you missed your entry, that's how you will go about it. Do you understand? So there should always be a reason to enter the market, and your reason should always be a high probability, I mean, reason that no, this particular one will move the market to the upside. And so that's what you do. That's how we trade, because trade is a risk taking. And if you are not making the right decision and somebody is making the right decision, you will be losing, the person will be gaining. And so you have to make sure you make the right decision every day. In fact, the amount of money that is being invested in even Bitcoin every day is so huge. So all you need is come on the market, make the right decision, tap into that, take some, and then you go and enjoy it. So that is Bitcoin for today. That's how we are going to trade Bitcoin for today. Then from there, we'll move on to gold market and we'll check the other ones as well. Um, please, do you understand? Gigabyte. Gigabyte, do you understand? Gigabyte, please. Do you understand what I'm saying? So first, you have to stick to just one thing and practice it over and over and over. Very clear. That's fine. So stick to just one thing. Okay. First of all, if you've missed an entry, okay. If you are missing an entry, meaning that the market was previously at a resistance area or at a support area, and when you came, the market has moved strongly away from that. Okay, that is, you've missed your entry. Okay, if you've missed your entry, how are you going to enter? How are you going to take advantage of that trend? That's where, in fact, especially that's where this particular pattern, the Harami pattern, I really like trading Harami pattern a lot. In fact, not even a single trader, Meme trader, America said, with this particular trade, I did not trade a Harami pattern, especially if I'm trading a short-term entry. I usually trade Harami because oh, whether you like it or not, once Harami pattern from the market, the next 30 or 1 hour candle is going to be bearish or going to be bullish, and you take advantage of that. So me, I'm the type that if I'm joining a short-term entry or a short-term trade, I really like Harami. I really like it. And many people, I mean, everybody and then the pattern that they like trading with. Okay. So, for example, look at this area. We realize that this area is a resistance area. This market is also revolving around that area, and we saw this huge bearish engulfing bar. What are you waiting for? Once you saw this huge bearish engulfing bar, you've got nothing to wait for. Just sell. Place your stop loss just above the close of above that candlesticks and target um, the next support area. And look at the risk to reward ratios, about 5 to almost 7. So usually when you take the market, if you join the market at a resistance or at a support zone, you are unlikely to fail, especially after there is a sweep of liquidity. So you always have to wait for the liquidity to sweep the previous close of the market to be swept. Once it's swept, and then you see that and confirmatory pattern and you enter, you are high about 70%, probable of winning that particular trade. Please, any other question whilst we are waiting for an entry? Any other question? Please, any question? Any question? Okay, so if there is no question, then as usual, we will have to wait to get an entry before you enter because already we've missed this entry and the market is likely to reverse at wherever it is right now. And so we will have to wait to get that entry before we enter the market. So I'll try my best. At least if every day, you know, we are able to take some profits every blessed day, that's going to be okay. So please, if you have any question, you can ask whilst we are waiting. So please, if there is any questions, please you can ask. So, and then if you see anything, in fact, the major pairs that I place over there. So if you see anything at all in any of the time frames and you think you can draw my attention on it, then if we have to trade that, we will do that. If it's not valid, we will ignore. So whilst we are all waiting, if you see anything, any of the confirmatory patterns, if you see anything in any of the currency pairs, either gold, any of them, and you think it's worth trading, please let me know. So, guys, once we are waiting to get an entry, I suggest that we can, we can end the live, and then when the signal is showed up, then I'll put it on the page. So always try and then be online. Okay, so now we have a picture of how the market is going to move. Let me see. I think yeah, everything I join you deal with them. Let me check this 5 minutes. Uh-huh. No, let's wait. Guys, can you hear me? Can you hear me, please? Let me check one. No, we include the answer. And then this. Yeah, we can enter this as early as possible to the sell side. Guys, let's see when the 5 minutes candle close. In fact, we will sell, we will join. This is so nice. So it should close before. One, two, three. So let's wait. Let's wait. I hope you will get a very nice entry, Lipan. $70. That's also good. That's also good. So please, I'll end the live for now. When the signal showed up, I will alert you guys. Okay. Mr. Henry, please, do you agree with me? So once the signal showed up, then I'll alert you, and then we will trade. So thank you all for joining.